One of the most important topics in all of finance is that of budget and planning. Planning for the future, planning for sales, planning for what's going to happen within the organization. We plan at every detail level. So it's not just a matter of doing one plan for the year, which is just an annual plan. It's not a matter of doing it for one location. In a large retailer, you would plan for every department and the categories within the department. You would plan for every location, and you plan by the week. In the retail world, we oftentimes plan down to that level of detail because we need to know what's happening sale by sale and event by event. We plan for the merchandise. We have to have our buyers purchase the merchandise at the right time, and we need to have it show up at the right time. And that all has to match up to specific sales days. We also plan for growth. So if I'm going to grow an organization, build a new store, it takes money, it takes cash. It also takes cash just to grow within your existing facility. So we talk about same store sales growth in our planning. When we talk about buying, the buyers need to know not only how much merchandise, for instance, how many shirts to buy, how many pair of trousers to buy, but how many long sleeve, how many short sleeve. They have to know by season which items sell by the season. So it's a lot more than just the accounting that figures into the numbers. But we take those sales plans, including the markups, how much margin I'm going to make on them, and the markdowns, how much sales discounts I'm going to give, to come up with a designed margin for every department, every category of merchandise within the store. And in this chapter, we talk about the stock turn or the sales turn. How often do I turn over those assets during the time period? We certainly don't expect everything to sell at the same rate. So fashion might sell at 4 times a year, once per season. Milk and bread, certainly, I don't want to buy any milk or bread that has been on the shelf longer than a few days. So each commodity and each type of thing in store moves at a different speed. Once we have planned for our revenue down at that detail level, and we know where the sales are expected to happen and when they're expected to happen, we can then build an income statement from the operation. An income statement then tells us how much revenue and profits we're expecting to make. It becomes a measurement stick that we can tell how we're doing. So if you're a manager and you build a budget and you have to live to that budget, then you can be measured by that in terms of your performance. We then think a little bit about the cash of the company. We buy a lot of things on time, so we will tell someone to ship us merchandise or order something, and they'll give us an invoice. An invoice usually has terms on it that, for example, may say pay in 30 days or pay in 60 days. So we plan for when we're going to make our payments. Same thing for when we're selling merchandise. We may sell some things on credit. We may sell some things just for cash. If I give people credit, then that's a use of cash. I can't spend. I have an accounts receivable. So all of those kind of things have to be planned for when you develop an architecture for the next time period. Sometimes I think the author here is a little simplistic in the view because they just talk about having level production for 6 months. Many companies never have level production in 6 months. They have to plan to have different amounts every month in their structure. So when it comes to paying the bills, I don't want to run out of cash, so I have to plan cash. Certainly, we all expect our paycheck to be cashed and on time, and vendors that we buy merchandise from expect to be paid on time. So we have a cash plan. So here's your income and finance statement, and we have a cash plan. You put the two of them together for a time period, and that tells us what our future balance sheet ought to look like. Finally, we do capital expenditure planning based on on the cash flow it generates. So if I'm going to buy a new building or I'm going to buy a major asset, that takes a certain amount of cash to do that. So I have to look and plan for the cash flow and how that affects my cash. Chapter 12 is probably the second most important chapter, and that's the one on capital planning. There are a number of different methods used to budget. One of them is called pro forma budgeting. We look at percentage of sales. We get different ways of projecting what the future is going to look like. But in essence, what we do is we go through and develop a budget for the future based on what we know from the past and what we're projecting to happen in the future. This all starts with a sales plan where we have a sales projection and we determine how many units are going to sell, what's going to happen to the price, whether we're going to have inflation or deflation. And once we know how much we expect to sell, we have to plan for production or purchasing the goods. If we're doing a manufacturing type operation, we're going to take the labor and the materials that go into the particular products and some of the overhead of the facilities and include them in the cost of goods sold. But eventually we develop a purchasing plan so we know what we're going to buy and when. And that tells us pretty much when we're going to need to have cash. So we're going to need to have labor for each of the months. We're going to need to have expenses in each of the months. But in terms of production, we're going to need to know what materials are needed, when they're needed, and so we develop a cash budget. Cash budget also gets an input from the capital budgeting process. So if I need to build a new facility or acquire a new truck, that's part of the input since that's a use of cash. Now, once I have a cash budget and a sales projection, I can build myself a pro forma income statement. That income statement shows me my revenue and my expenses, and it can be planned down to very intimate detail. So I would expect to have things for various utilities, electric, gas, water, sewage, those kind of things would all be in the plan, but we would also plan for maintenance and other things like that to go into this income statement. So I would have the revenue from the sales minus the income that would occur during that time period. Now, I have a prior balance sheet from a prior period, and so with that, with a cash budget, I then can create a pro forma balance sheet. This is a look at what the future is going to look like based on what the past looked like. A lot of our focus here is going to be on this income statement and how we develop that, and we'll talk about the cash or the requirements for new funds or requirements for cash. Done. This is the plan for the future that tells us how we're gonna operate our company over the next time period. This allows us to take a good look at what the future is going to be for the company.